Have you heard the buzz about ULIP index funds? With the rising popularity of index funds and mutual funds, insurance companies are entering the scene with ULIPs that look like index funds. But is this trend a golden opportunity or a potential pitfall? In this video, let's dig into it and find out. Welcome to holisticinvestment.in. ULIPs, often disguised as index funds, are being promoted by insurance giants like Max Life and PNB MetLife. They are targeting the appealing small cap and mid cap sectors, which have recently shown strong performance. These companies have introduced funds like Max Life Mid Cap Momentum Index Funds, PNB MetLife Small Cap Fund, given the impression of traditional index funds or mutual funds. However, there is a catch. These funds are actually ULIPs in disguise. ULIPs or unit-linked insurance plans come with hidden fees and features that differentiate them from mutual funds. When investing in these ULIP index funds, you are not just gaining market exposure but also paying for life insurance coverage and ULIP related expenses. It is similar to purchasing a designer outfit only to discover it carries a substantial maintenance cost. The missing piece in the puzzle. While ULIPs combine insurance and investment, they come with extra drawbacks like higher charges, complex fee structure, and lock-in periods that restrict liquidity. Before dwelling into ULIP index funds, it is crucial to conduct thorough research. Always scrutinize the terms, seek advice from a certified financial planner, and comprehend what you are committing to. While these ULIPs might promise exposure to lucrative sectors, they also entail added cost and complexities that could impact your returns. Make a well-informed decision that aligns with your financial objective and risk tolerance. Next, why should you think twice before investing? ULIP index funds from life insurers are generating interest among investors, promising a blend of insurance and investment benefits. However, a closer look reveals several factors that warrant caution before diving into these products. First, distinguishing ULIPs from mutual funds. One of the primary challenges investor faces is differentiating ULIPs from mutual funds. Despite their similar names and impression, they give off being traditional investment avenues. ULIPs and mutual funds operate under distinct regulatory frameworks, while mutual funds are governed by market regulators like SEBI. ULIP falls under the purview of insurance regulators such as IRDAI. This fundamental difference impacts various aspects including investment strategies, fee structure, and liquidity options. Next, evaluating cost structure. Another key consideration is the cost associated with ULIPs compared to mutual funds. ULIP often carry higher charges including fund management fee, policy administration charges, and premium allocation charges. ULIPs can charge fund management fee up to 1.35% per annum as regulated by IRDAI. In contrast, direct mutual funds typically offer lower expense ratios, making them a more cost-effective option. The difference becomes even more apparent if you compare the cost of passive funds to ULIP funds management fees. On top of fund management fees, ULIP may also come with premium allocation charge or policy administration charge. These costs can erode investment returns over time, making it crucial for investors to carefully assess the fee structure and compare them with the cost efficiency of mutual funds. Next, understanding the lock-in period. A critical aspect of ULIPs that investors must grasp is the lock-in period. Unlike mutual funds, which typically offer flexibility in terms of entry and exit, ULIPs comes with a mandatory lock-in period, often around 5 years. This lock-in feature can significantly impact liquidity and the ability to reallocate funds based on the changing market dynamics or personal financial goals. ULIPs do provide the option to switch between funds offered by the same insurer or fund manager. However, these switches may come with restrictions and could reset the lock-in period, affecting the investment flexibility. Understanding the implications of switching funds within ULIPs and how it aligns with your investment strategy is crucial for optimizing the investment outcomes. Next, assessing investment performance. While ULIPs may offer exposure to market indices through index funds, investors should delve deeper into the potential for investment performance. Factors such as tracking error, fund management expertise, and the impact of cost on returns can influence the actual performance of ULIP index funds. Considering the tracking error and the high cost involved, ULIP index funds may significantly underperform the index in the long run. Even a small difference in performance can compound over time, leading to substantial difference in returns compared to the market index. Conducting thorough research, evaluating cost structure, analyzing historical performance, and assessing the impact of lock-in periods on liquidity are essential steps in making informed investment decisions. In conclusion, let's recap the key difference between mutual funds and ULIPs index funds offered by life insurers to ensure you make an informed investment decision. First, not all funds are the same. Just because a product has funds or index funds in its name doesn't guarantee it's a mutual fund or index fund. Many life insurers promote ULIPs as index funds, which can confuse investors seeking genuine index funds. Next, importance of due diligence. Before investing, conduct thorough due diligence. Consider factors such as total cost of ownership, lock-in periods, and potential for underperformance. Approach it like buying a car. First, research features and mileage and reviews before making a decision. Next, making an informed decision. Do not be swayed by names or marketing tactics. Always read the fine print and fully understand your investment. If considering ULIPs labeled as index funds, carefully weigh the advantage and disadvantages. Next, seek professional advice. Consulting a certified financial planner can provide valuable insights and help navigate investment complexities tailored to your needs. In closing, investing is personal, and what suits one investor may not suit another. By grasping the distinctions between ULIPs and genuine index funds and evaluating critical factors like cost and flexibility, you can make a decision aligned with your financial objectives and risk tolerance. Knowledge empowers, so equip yourself and make informed choices for a secure financial future. A detailed blog post on this topic is available in our website, and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming Enlightening Investment Webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.